To this conversation now, recent analysis from the National Planning Commission highlights that structural financial reforms in South Africa could unlock as much as 3 trillion rands in investment, and this would be for infrastructure and clean energy projects. This now represents an unprecedented opportunity to accelerate economic growth, to improve service delivery and create jobs across the country. For more on this now, we're joined by Danie Dorfling, who's Head of Business Development at More Infinity. Thank you so much for your time this hour. So much talk around reforming pension fund regulations as well as development finance institutions, particularly when we look at how all of these institutions are set to make life easy for people, but also some of those policies to be fit for purpose.
Absolutely. And if we firstly just break it down into its simplest terms, the report's core argument is that South Africa's problem is not a lack of capital. It's a misalignment of financial architecture. And as you rightfully mentioned, there's a significant pool of savings that sit in pension funds, that sit in banks, that sit in corporate balance sheets. But too little of that is being directed into fixed investment, particularly infrastructure and for the just transition. So instead, funds flow offshore into financial assets, into government debt, and the report proposes a deliberate reconfiguration of balance sheet across the public and private sectors so that the existing capital is more systematically channeled into long-term productive investments without relying on radical shifts in interest rate or fiscal policy. Now, the question you might be asking is, well, how realistic is this? The quantum is arithmetically plausible, but from an institutional point of view, very demanding. The report's numbers are derived from credible sources of capital, as you mentioned, the modest reallocation of pension fund assets, expanded DFI lending capacity under the South African Reserve Bank supervision, and then obviously more effective use of SOE balance sheets and a small redirection of bank lending. So what are the propositions and what's being proposed from a pension fund reform point of view? So essentially, the report recommends a targeted adjustment to Regulation 28. Rather than a crude prescription, like some would imply. So there's a gradual reduction in the 45% offshore limit, which would be linked to the availability of credit or credible domestic infrastructure opportunities. And then obviously a requirement that funds prepare and report on annual infrastructure investment plans. So they ensure that the asset classes is obviously systematically considered rather than incidental. And lastly, there's a relaxation of certain unlisted asset constraints, which recognize that the most infrastructure is not listed. You made mention of the fact in terms of the Reserve Bank and the DFIs. So one of the suggestions as well is Reserve Bank supervision and how that affects long-term project financing. So if we bring the DFIs under the South African Reserve Bank's Prudential Authority, which is intended to strengthen their capability and then obviously expand balance sheets, that would allow them to borrow more at obviously lower spreads from capital markets and other lenders. So if this is designed appropriately, this could multiply their capacity for fund long-term investments. So the report cites potential expansion from a few 100 billion rands to roughly 1.4 trillion from major DFIs.
Clearly, the possibilities are now endless when we look at this and the greater picture that also comes with it, because I want us to also explore the potential impact on various sectors such as infrastructure, such as renewable energy, as well as employment, because those could certainly use a boost.
Certainly so. And there are 3 sectors that are particularly well positioned. The first, as you rightfully mentioned, electricity and transmission. So there's a clear, urgent need to get an established independent power producer track record and a defined transmission expansion plan, including the National Transmission Company's independent transmission products. So this is the natural first candidate for blended structures involving whether it be DFIs, pension funds, and then obviously guarantees. The second being water. So the investment requirement is very large, of course, but both in bulk water and wastewater treatment, but the macroeconomic case is quite strong. The weakness, however, is in municipal capacity, which will limit the pace and scale at which the capital can be productively absorbed. And finally, interestingly enough, digital infrastructure. So assets like fiber networks, like towers, like data centers, they're already recognized as infrastructure under Regulation 28, and they tend to have a clearer commercial model and shorter implementation timeline. So from a transportation and logistics point of view, particularly in freight and rail and ports, they offer a high potential as well, but progress will obviously be contingent on governance and reform outcomes at Transnet and related entities. You made mention of whether these reforms could materially increase employment and growth. I would say cautiously yes, but that's only if they translate into well-chosen and well-executed projects that can move South Africa onto high investment and growth paths. So there needs to be sustained increases in gross capital formation, especially in network infrastructure, which generally raises the trend growth by improving productivity and reliability, and then obviously employment, both directly in construction and then indirectly in more competitive operating conditions for firms. So the most durable employment gains would not come from construction alone. It would obviously come from improved conditions for small and medium enterprises, which is our bread and butter from a more Infinity point of view, and already accounts for a majority share of employment, while large firms provide roughly a third. So in realistic terms, if around 2 to 3 trillion were deployed effectively over the decade, the impact could plausibly be hundreds of thousands of net additional jobs and a meaningful uplift in growth. But that's obviously not an overnight solution to structurally high unemployment.
And I assume that would need all hands on deck. Let's talk about the practical steps, that government as well as investors and business leaders can, take to turn this, all those grand plans that we talk about into a reality, particularly when we look at, strengthening capability and everything that you make mention of now.
Yeah, so there are essentially 3 sets of actions that stand out as priorities. I think, as you firstly mentioned, from a government point of view, we need to provide clarity on SOE governance and ownership structures, so particularly around the proposed holding arrangement, and that would reduce uncertainty for investors. We also need to fast-track a small number of flagship high-quality projects. So if we use the transmission example, that could create, and if we then create transparent procurement and robust contracts, that's the first or the second step. Thirdly, government needs to operationalize the credit guarantee vehicle. So independent governance needs to be looked at this strictly for commercial criteria and for guarantee issuance. From an institutional investor point of view, being with measured voluntary commitments to well-structured infrastructure platforms such as the infrastructure fund under the stringent risk and government requirements, that's what they could do firstly, and then obviously engage proactively with government and DFIs, because they need to co-design standardized instruments that meet these portfolios needs. And lastly, banks and corporates. What they should do is they should establish dedicated infrastructure and SME financing capabilities. That would be, rather than treating these as marginal to existing business models. And they should form credible consortia to deliver and operate infrastructure assets at scale. So the overarching principle here is to demonstrate success on a manageable scale first, a proof of concept type implementation plan, and then obviously build out from those examples.
Right, I must thank you so much for giving us a better understanding of all of those terms. That's Danie Dorfling, who's Head of Business Development at More Infinity, joining us there to chat to us about the recent analysis from the National Planning Commission, highlighting the structural financial reforms in South Africa that could unlock endless possibilities in investments. Thank you so much indeed for your time.